orders, let's forget about spoofing altogether. One of the basic core ideas of any trade is that the market rotates round a balance, right? So this is the basic core idea of a market narrative. Inside of this market narrative, we've obviously got this idea of premiums and discounts. One can imagine that if we start looking at price from that perspective and seeing this narrative unfolding here, and assuming that this is the same narrative that unfolds all the way through this entire picture, you'd imagine that in terms of limit order books, as the price goes higher, we would naturally be inclined to be seeing the limit order book getting heavy on the sell side stack. And as the market tops out, we'd imagine that they would then kind of go flat for a while, and then they would go heavy on the buy side stack. And then when the market bottoms out, that they would go heavy for a while, and then they would go heavy on the sell side stack. And then when the market tops out again, they would go flat for a while, and then they would go heavy on the sell side stack. So you can see here that in terms of a normal theoretical construction of the market maker's proxy, it would be very obvious that this should normally be a simply negative correlation. And as the price reaches periods of liquidity into top edges or bottom edges, then we could expect to see markets reversing round. This suggests that there are no informed traders. Do you agree with that? Would you agree that this model has no informed commercial trade entities? Why? Because if that was the case, no informational. Because if that was the case, you wouldn't have the market maker doing what they did. If, for example, we then come into the bottom edge here and it suddenly goes like this and the market maker does that, is that informed trading? Yes, it is. Something's changed. This is now informed trading at this point, suggesting that this market is now likely to be going higher at this point. Because at higher prices, it should never be at the top edge. The limit order book should never be bullish at a top edge. Unless, of course, we start factoring in the concept of spoofing, which causes obviously a lot more difference in how this is interpreted. But based on a basic theory where we've got to start with, this is normal. So when we see, for example, this NASDAQ, you can see exactly what's going on. The market goes up and the limit order book goes down. The market goes down, the limit order book's still coming down, goes up, comes down, the limit order book goes up on the downside. So there's your buy trade. The limit order book starts to come down as the price goes up. You start looking at the high price liquidity and you sell into it. Crazy way to trade, isn't it? You could see it's a very, very effective way to trade simply just on that one single piece of charting right there. And you can see that that's not chump change either. That's over $1,000 on that short sale. Off the buy trade here at 36s, that's also another $600 on the buy trade away from this bottom edge. So if you forget all the other lines and you focus on that proxy for the HFTs, this yellow line is your HFT proxy. You're very rarely ever too far away from the truth. You're very rarely. Now, sometimes, yes, they spoof, and that's just unfortunate. But you can see a top edge here on oil. Top edge, you're not far away from the proxy there, are you? Gold. You see the sell opportunity into this liquidity here? See it? You're not far away from the truth. You see all of those lovelies? Some very, very, very nice, lovely opportunities to do some business in there, isn't there? Crazy, crazy, crazy. We love a bit of crazy. S&P on a 25 delta. Top edge liquidity there. See how they ran the stops? See how the limit order book doesn't move, but it stayed in the short sell? And if you look at that from the background, you'll see that that short sell stays in place after that top edge was available there. And then this liquidity was grabbed in here on the S&P as well. It's nice, isn't it? It's nice. It's nice indeed. On a time chart, same kind of thing, same kind of basic idea here on a time chart. You can see exactly the same. Top edge liquidity, selling coming in with the liquidity there. Top edge sell side business there. Top edge sell side business there. It's not going anywhere, but based on this, you're very rarely on the wrong side. You're very rarely on the wrong side of history because you are lining yourself up with the algorithms. And if you line up with the algorithms will spoof, but usually the spoof is on the other side of the trade. So they'll maybe spoof a buyer into a top edge or spoof a seller into a bottom edge. If this is being used as part of your fading system, then you can obviously try and lean against this as part of your fading system. And obviously the idea is that this should then line up with the other proxies that are taking place. The other proxies, of course, are things like your value narratives. If the value narrative adds up with this, you're in good shape to deal. Now, I don't like the sell trade at the moment. Why? Because inflation is going down. The delta, the gamma line is positive, so I don't actually like the sell trade. You'll see this from this S&P chart here. You'll see that the inflation is going down, so I actually quite like the idea of buying into this liquidity at the bottom edge here. You know, I quite like the idea of maybe trying to push this back through to the top edges. So for me, it's not a sell trade on the S&P at the moment. So we just have to bear that in mind, that at the moment it's a buy on the S&P and a sell on the NASDAQ is more likely to be a spread trade. So obviously when you look at this NASDAQ, you can see that they've ran that. And again, as soon as they took out the liquidity here, the book went even more sell side. You see that? And that's because there's a lot of spread trades getting done on that particular little bit of trade opportunity there. You can also sense that there was a Charlie D reversal. Did you see the Charlie D reversal on that trade? Sure. A very clear Charlie D reversal came in from that bit of business. So if you saw it, you took it, you made some monies on it. You've just sold around about 71s on the short sell on a Charlie D reversal. It's currently trading 66s, and you have your stops at break even. Thank you very much. I've got my stops at break even. I got the short sell against the 72s there. So I sold against the 72s into that top edge there. On the NASDAQ, remember, I'm looking at the possibility of buying the S&P at low prices, but the NASDAQ is still a sell, top edge, liquidity, and that's been making some consistent, easy cash on the rotation so far. Let's see how it plays out. As I said, I'm quite keen to buy the S&P at these low prices against a short NASDAQ at the top edges. You know, so to me, it looks more like a spread trade until this kind of qualifies itself as a, you know, as a real money short or a real money long trade.